It's working. Good evening, everyone. We are pleased to have with us representatives from Davenport and Company. We have Roland Cooch and Ben Wilson, and they're going to give an overview of their findings relative to school funding.
Thank you, Dr. Woolridge, and I'd like to say thank you to Mr. Johnson and members of City Council as well. Dr. Woolridge and members of the board, we appreciate the opportunity to do this presentation for you and for the members of the school board as well, hearing it for the first time this evening. I'd like to, before I get into the presentation, just give you a little bit about sort of our history here. We've had the pleasure of working with the City of Emporia's financial advisor for well over 2 decades plus, and have also worked with the county for well over a decade plus. So we know the numbers, and we know the nuances of both the city and the county over those years, and have come to appreciate those relationships that we've developed. We've been asked to take a look at school funding and the school funding analysis that you'll see tonight at the request of both the city and the county. And this is our analysis, basically just the facts. And what we do is we're financial advisors to both the city and the county. We have routinely evaluated financial numbers and calculations and analysis for budgets, debt service, and the like. And what you'll see here tonight is our analysis and presentation of school funding and how that impacts both the city and the county, because as we all know, school funding is one of the biggest components of a local government's budget, and it's comprised of various funding sources, primarily comprised of local and Commonwealth state revenues that are passed along to local governments. And when you put all that in the mix, what you're going to see tonight is how that funding is sort of allocated between the county and the city in terms of funding for Greensville County public schools. So with that, I'll begin the presentation and give you a little bit of background on page 2. Kind of stole my own thunder here because we have served as the financial advisor to both local governments and gave you a little bit of background on that. At the request of the local governments, both the city and the county, we were tasked to look at the potential impact of financing a new school investment ranging anywhere from approximately $50 million to about $75 million. And that's a new school investment for infrastructure. And we felt that before we got into that cash flow, it's important to understand how the funding works between both the city and the county as it stands today, and how that analysis looks at under a variety of scenarios. We understand also that the city and the county have worked historically have worked under a contractual arrangement in order to provide education services not only to the county students, but also to the City of Emporia students under a contractual agreement. That historically has been in place, but we understand now that agreement has sort of lapsed or transpired. What we're talking about today, and what you'll see here today, is a order of magnitude sort of impact not only on the potential costs of a new school investment, but also how that can be allocated amongst the city and the county in terms of a variety of funding scenarios. So that's the purpose of our analysis and presentation today. So the goals and objectives that we undertook here to try to get to this analysis was to look at basically the current status and the allocation of local funding based on the FY 2023 budget under the scenarios that we'll be talking about. We are, again, going to look at the evaluation of a potential range of debt, both on the $50 million, the $75 million, under a couple of different interest rate scenarios, so you can see the cash flow impacts there. And we're going to take all that and show the incremental impact of the new school investment on the city and county's local funding for education, again, based on the 2023 budget as a starting point. That's the most current budget we have at this point. That's the data in this analysis is based on that. And then ultimately, we're going to pull all that together and evaluate a series of key debt ratios and metrics for both the city and county, and really try to get into an estimated budgetary impact, pulling this all into one big picture approach. So before we get to the scenarios, we felt it was good to provide a little bit of context in terms of some key data points. One of them is enrollment history. And what we've shown here is over the past decade, approximately the enrollments for both Greensville in terms of student body, as well as Emporia, and also the total enrollment of the two. And you could see that over the past decade plus, we're looking at enrollment that has declined in aggregate. Total enrollment between the two local governments declined from about 2,400, rounding 2,400 students, to approximately 1,900 in today's most current budget. What's important to note between the two is that the decline has occurred over both jurisdictions and both governments, but you can see generally the enrollment as a percentage, City of Emporia's enrollment as well as Greensville County's enrollment as a percentage of the total has stayed relatively constant. So wanted to make that observation because that's one of the analyses that looks at is percentage of enrollment, or enrollment as a percentage of the total. So Greensville's roughly is about 56 to 58% over this time frame, and Emporia's is around 41 to 42% over this time frame. The next page, on page 5, we looked at the local composite index and the history of the local composite index. What's important to each local government, and this is a calculation that's very important, it's done by the Commonwealth of Virginia. This is the calculation that the Commonwealth uses and represents the locality's ability to, and wherewithal to fund public education. The Commonwealth calculates this based on 3 primary factors. The first of which is real property, weighted the most, the assessed value of real property that's taxable, roughly at 50% weighting there. Looking at the adjusted gross income of the locality, that's weighted about 40%. And then lastly, taxable retail sales, weighted about 10%. What's important to note is that this LCI, Local Composite Index, or LCI, is essentially a calculation that determines the Commonwealth's funding for the local government. So the lower that this number is, the more funding that the Commonwealth provides on a per student basis. That's generally how this works. One of the things that we'd like to point out over the history of this until recently, that LCI was in the approximate same ballpark for both local governments. Emporia actually had a higher LCI over this time frame in the past than Greensville. Just they were in the same range, but Emporia's was slightly higher, which meant that Emporia back 10 years, a decade plus ago, had the ability to fund more on a per student basis than Greensville County. As we go through time, those two composite indexes kind of got really close and merged together, as you can see by that graph. And then by the time we get to the 2022 to 2024, we see that Greensville County's LCI has really gone up significantly as a result of investment in the locality itself. That's what's factoring into that increase in the LCI for Greensville County. So based on that sort of historical context of where enrollment is, relatively about the same on a percentage basis over the past decade for both Greensville and Emporia. So there's no real big change there, but we did see a change in the LCI. So you'll see that has been factored into the analysis that we have on the next several pages. So under the next section, what we've done is we've provided an overview of the scenarios that we've analyzed based on the 23 budget. And what we're looking at here, just one of the key points at the top I'd like to mention, is that the 2023 budget includes approximately $10.4 million in what we're calling local contributions or local funding for education. And that is distributed as follows or allocated as follows. If you look at the total local contribution, you can see that Emporia at the top is 4.3 million, roughly, in terms of the total local contribution. I'm sorry? Okay.
Can't read it. Can't
Yeah.
read it.
I'm sure we could change that. Yeah. We can't change the zoom in. Yeah. So the Emporia's total local contribution is about 4.3 million. And if you look at Greensville County's local contribution, it's about 6.1 million. That comprises the total of 10.4 million. When you look at to the right-hand side of that dotted line, that's comprised of two components. The required local effort that's calculated by the Commonwealth based on the local composite index, which is effectively the ability to pay. You can see that Emporia's required local effort is just under 2.1 million. Greensville County's is just over 5.3 million. Again, this is based on ability to pay and the number of students, of course, based on that. And when you look at the additional local share that comprises the total that each local government's putting into the pot for funding in FY23, Emporia is adding another 2.2 million approximately, or adding another 100% of funding effectively there. And when you look at the additional local share that Greensville's built into the budget there, it's approximately 825,000 rounding. That's about another 15% over and above what the required local effort is. So when you look at that, we can see the numbers there and what comprises the total that each locality is putting in based on the required local effort, as well as the additional local share that's being put in. What we've done is we've looked at the analysis herein for these four scenarios is comparing different methodologies for allocating that $3 million of additional local share. Based on the four scenarios as follows, looking at an ADM method only, based on student enrollment for that local contribution only. We know that under scenario 2, we've ran the prior formula. This is the prior contractual formula that Emporia and Greensville County had under the prior contractual agreement. This attempts to adjust the funding mix based on taking into account the LCI of each locality. It does that by adjusting enrollment, and we'll go into that calculation. The third scenario really kind of tries to take scenario 2 and adjust it a little bit further and fine-tune it. It really uses the LCI, the local composite index of each locality, as a percentage of the total. So we're trying to get into this concept of weighting the total local contributions there based on those formulas. And then the last scenario 4 method really takes into account all of the sources of funding, both the Commonwealth state revenues, the state sales tax that are allocated, that are coming through from each local jurisdiction for education, and this total local contribution, and really divides that and arrives at a total or an equal per pupil cost based on all the costs and the total number of students. So effectively, that last bucket, that last scenario, puts everything in the mix, and if you're funding all the students on an equal basis, both localities bring the different resources to the table. Each locality is paying an equal per student cost based on a combined state and local sources of funding. So on the next page, we've run the scenario, the ADM method, based on the 2023 budget. And this, again, is the scenario that really just says how many students, go ahead, Mr. Johnson. Sure.
I'd like to, can you guys take it back to screen, please? To the funding mechanism. minimum required by the state. I think that was, sorry, can you hear me?
Regional average.
That's what David said in the
Yeah.
previous meeting. So my point that I'd like to make is because there is criticism from time to time that we don't fund appropriately, that between the two governments together, based on state averages, only on state averages, we do fund appropriately.
Yes, and I would say, I would agree with that, Mr. Saunders. When you look at the collective funding, though, that 15% on Emporia, I'm sorry, on Greensville, and 104% on Emporia, when you look at the collective of the two, that's 40% more than their local required effort. So you're funding appropriately in that respect. You're not just funding the bare minimum. So going into scenario one, again, as we've talked about this, this basically takes the ADM method as applied to the total local contribution only. What this does is, if you look at the table at the top, we're simply dividing the number of students by each local jurisdiction, Emporia and Greensville County, divided by the total that's in the system, and coming up with a percentage. As we talked about, the background that we provided for this is the historical relationship between Emporia students that they send in terms of number of students and Greensville County that they sent over the past decade has roughly stayed in about the 58% range, 56, 58%, 42 to 43% for Emporia. So that stayed relatively constant over that time frame. So this is not out of the norm in terms of a shift in student body. This is what the student body has been historically. So this method, though, takes that ratio, the 58% here and the 42% for Emporia roughly, and basically applies those percentages by the total local contribution of 10.4 million. What this does is that's ADM only on the 10.4 million, and when you add in the state revenues that come into play, that the Commonwealth provides, the local sales tax for education that comes through and is dedicated straight to education, when you add all that together with a local contribution that's, again, comprised of two components, the required local effort as well as the additional local share, and do the math for both Greensville and Emporia, you can see that looking from Emporia in the middle of the page, on a per student basis for the 783 students, they're effectively funding $19,064 per student. And for Greensville, with all the numbers coming into the mix, they're funding effectively $17,129 per student. That's the simple math calculation based on this approach. And the difference here is that Emporia on a per student basis is contributing about $1,934 more. We'll see on the next several pages how that number can shift. So on page 2, scenario 2, page 9, this is the prior formula. It takes into account, or attempts to take into account, the differences in the local composite index. So the way it does it is a pretty complicated formula, but it's at the top of the page. Again, we start off with a budgeted enrollment. That number didn't change. We still have the 783 for Emporia, the 1,117 for Greensville County, total of 1,900 students. But then what we're doing there with the formula is we're adjusting that enrollment down based on the lower local composite index. So here in Emporia's case, we're adjusting that enrollment down and coming up with an adjusted percentage. Now, if the local composite indexes were flipped as they were a decade ago, Greensville counties would be adjusted down. So this is designed to work both ways. Here we just have a composite index where Emporia's got the adjustment because it's the lower LCI. So when we do the math on that, we come up with a different percentage. You'll recall in the previous percentage in scenario 1 was based on just a straight percentage of enrollment as a percentage of the total. 58, 42, roughly thereabouts. Here, based on this adjustment, we're coming up with a 29% Emporia and about a 71% for Greensville County. That's attempting to take into account the lower LCI, which is a reduced wherewithal to pay. That's what the attempt is to do here. So when we apply those adjusted percentages by again, the total local contribution of the 10.4 million, we get an adjusted number, and we do the math. We see down at the bottom of the page, the total per pupil cost that's being funded for Emporia now is $17,459. Greensville's is $18,254. What this means is that now this formula has swung the other way and has caused Greensville now, under this calculation, to be funding more on a per pupil basis versus Emporia, which is funding less on a per pupil basis. You can see that the difference, we've quantified that in difference in terms of the budget. So if you think about Emporia, if we were doing this calculation and compared it to the 23 budget, that $4.2 million, this calculation results in a $1.2 million decrease in that budget. Conversely, Greensville's counties, you got to fund it from somewhere, then the math that shifts over to Greensville County causes a $1.2 million increase in relationship to the FY23 budget. So this formula clearly swings the balance the wrong way. It causes a reduced per pupil cost relative to Greensville County's higher per pupil cost. So on scenario 3, page 10, we attempted to say, is there a different way of looking at the local composite indices to see if we can come up with a mathematical formula that kind of brings us back into balance. So what we did here is said maybe the relationship is with the local composite index as a percentage of the sum of the two. You know, what is that ratio or the pro rata share there based on the local composite index? And what we did here is we've then applied that to a subset of the numbers we've been talking about here. We've applied that to just the additional local share, because we know the Commonwealth is governing what the required local effort is for both the Emporia and the county, city and the county. We said that additional local share of the $3 million, we said let's split that up based on a pro rata of the LCI. What we did here then is based on the calculation percentages of the LCI, 37% for Emporia and 63% for Greensville County, we applied that just to the $3 million additional local share. Said, okay, does this bring it back into balance? Again, when we look at this approach, one of the things that it does is it does reduce Emporia's local funding, but it reduces it more than needed, and you could see that the total per pupil funding, the per pupil cost being funded, is $17,684 per student for Emporia, and then $18,096 for Greensville County. A difference of $413 spread between the two numbers, but you can see it is giving the benefit there to one local government versus the other. It's not equal in this respect. Each of the scenarios you've seen here, scenario 1, 2, and 3, either swung the numbers one way or swung the numbers the other way in terms of a per pupil cost. When you look at the Greensville County Public Schools, all the pupils are going to one system. That per pupil cost is one number based on the total number of students. When you look at the funding that each local government pays and is contributing, if one is paying below the per pupil cost, there's a benefit there, implied benefit. If one is paying higher than the per pupil cost, there's implied, sort of cost there, an increased cost. What we're trying to do is bring those numbers in balance when we think about what is the total cost to educate the students in the system. So where that led us to was scenario 4. And scenario 4 is equalizing the per pupil cost based on total funding sources. What that does is that takes into account the Commonwealth's calculation of the local composite index, how much they're providing to each local government based on the LCI and the number of students that they're sending to Greensville County Public Schools. And it also takes into account how much additional local monies, that 40% extra that both local governments are contributing to, how that's distributed between the city and the county. So what you can see at the top of the page is if we look at the budget, the total FY23 budget, that's total Commonwealth, sales tax, and local funding, that's approximately a $34 million budget. We then broke it down on a per pupil cost, essentially divided by 1,900 pupils, that's 17,926 per pupil. So when we look at the math and say, what is the number that each local government should be paying per pupil, should be mathematically on an equal per pupil cost basis, 17,926 times the enrollment that they're sending to the system. And you could see that Emporia's total Commonwealth sales and local funding is approximately 14 million. Greensville's is approximately 20 based on this calculation. And again, looking at the math here, it's straightforward math. How much on a per pupil basis, all things being equal, then however many students and pupils you send to the local jurisdiction, you're paying that much times that number of pupils. So what we did is when we ran the numbers in the table below, you could see how the Commonwealth revenue is different for each local government. Now, that number is based on the LCI calculations and how they allocate funding based on LCI. It's also based on the number of students that are sent. Local sales tax is local sales tax. That's based on what's derived from the local government in terms of local sales, and that's dedicated straight to education, so that's put into the mix as well. The required local effort, now that's the Commonwealth calculation that has not changed. That's still what's calculated to be the minimum amount that should be funded by the local governments based on the Commonwealth's calculations. And then the additional local share, that number represents that additional $3 million over and above the required local effort of $7.4 million. So we have the same numbers going through the scenarios that we had in the previous three. And when we calculate all of this together, we're balancing out the additional local share to arrive at an equal per pupil funding, equal per pupil cost, equal per pupil funding, 17,926 for both the city and the county. And you can see that it's equal, there's no difference between the two. What this means, though, is that the adjustment, or what the difference is relative to the FY23 budget, Emporia's FY23 budget is approximately $4.2 million. And when we look at this calculation, the calculation's arriving at about a $3.4 million number. So that, to balance this out, that means then that effectively should theoretically be, and calculated to be, about $890,000 lower on the city side based on these calculations. That correspondingly is $890,000 higher on the county's calculations. When you do the math, both local governments are paying the same per pupil cost. On page 12, we just put this in here as a straight side-by-side comparison or top-to-down comparison from scenario 1 to scenario 4. And we put this in here relative to scenario 1, which is based on the 2023 budget. And you could see how the differences change. And those are the numbers in the box. So for the Emporia calculation under scenario 1, 2023 budget, that's ADM based on the total local contribution. You can see 4.3 million roughly for Emporia, 6.1 million roughly for Greensville County. And as we go through the numbers, you can see how that's adjusted based on the formulas. We talked about scenario 2 and scenario 3, not quite hitting the mark because it still causes an imbalance in the per pupil funding and the per pupil cost that's being funded by the city and the county. When we get to scenario 4 at the bottom of the page, both the city and the county are funding an equal per pupil cost basis there. And you can see that relative to the 2023 budget, the scenario 4 is showing 3.4 million is the calculation from the city, and about 7 million for the county. That's that adjustment of roughly 890,000 that shifts from the city to the county in this calculation. Next couple of pages, we just put in bullet point form the math and the numbers and which local contribution or per pupil cost exceeds the other numerically. I don't have to belabor this, but simply stated, ADM, the ADM method causes the city's total per pupil cost and funding to be about $1,934 more than the county's. Scenario 2 adjusts it the other way. The county is paying more under this scenario by about $796. On the next page, scenario 3, again, we're trying to bring it closer and more equal. The county is still paying more than the city by about $413 per pupil. And scenario 4, again, equal per pupil costs, so there's no local governments paying more or less to educate the same student in the same school division. So with that, before we get into the new school funding, I wanted to take a break. I've been talking quite a bit here on this. If there's anything with respect to the numbers or the methodology of the calculations, be glad to field some questions.
Ready? All right, I'd like to make sure I understand on the different scenarios. This is something that the mechanism would change annually depending upon the number of students, budget, et cetera. I guess the composite plays some part in it.
Yes.
Because as time goes forward, depending on economic development, that composite number can change. So how often does the state come out with a new composite? Is it every 2 years?
Every 2 years. It's every biennium. they
Okay,
come out with
so
that.
if you had that every 2 years, you would look at the change on that part every 2 years, but you would look at the number of students on an annualized basis.
Correct.
To keep it in balance going forward.
That is correct. So, Mr.
so-
Saunders, that, just to sort of reiterate your question there, this scenario 4, we're talking about scenario 4, that formula would take into account changes in local composite index every biennium. It would also take into account changes in enrollment per locality. So even though, let's say for example, if Greensville's local composite index was still higher, but let's say their enrollment went significantly lower, then it would still take into account the higher local composite index and the lower enrollment in arriving at that calculation and balancing out the local funding.
Based on the strength of each factor that goes
Correct.
into that calculation. Okay, thank you.
So the next section is an analysis or the impact of new school investment. And the new school investment, we did talk about, we've ran a couple of potential scenarios or sort of order of magnitude scenarios. One of which is 50 million and the other is 75 million, to give you a range or a sense of those calculations. We did run 2 scenarios based on those as well. Case 1 is a 3% interest rate. This assumes the potential, if there is the potential to access below market Commonwealth loans for at least a portion of the financing. That's a 3% sort of blended interest rate. Case 2 is a planning estimate for just current market rates, about a 5% cost of funds on the entire debt that would be issued. We did look at 2 of the 4 scenarios we discussed here. Scenario 1, which is the current situation, the current allocation of the total local contribution. And then scenario 4, which is the equal per pupil cost method, really the equality in terms of funding by both the city and the county. Scenarios 2 and 3 were just kind of intermediate steps to get to scenario 4. We assume the debt service to be issued in 2024, so debt service does pick up around after that and wraps around. So effectively what we're saying is we're not trying to overburden the payment. So effectively the payment steps up for the total payment to be factored over the life of the bonds. And wanted to note that within all these numbers, the existing debt service is already factored into the budget. So we're taking that into account as we go forward. So on the next page, this just gives you an understanding of the existing debt service for Greensville County Public Schools, comprised of principal and interest on the left-hand side of the page. You can see that it's roughly about $970,000, slightly declining, but the debt service ends and the debt is paid off after 2029. That's the last payment for all the debt. And you can see that on the right-hand side of the page, it's comprised of really 2 issues of debt, both done through the Commonwealth of Virginia's VPSA program, Virginia Public Schools Authority Funding Program. On the next page, we're then looking at the projected debt service based on a 3% interest rate. And again, we're looking at a $50 million scenario on the left-hand side of the page, $75 million scenario on the right-hand side of the page. That payment is higher at just under $4,040,000. Of course, we're doing $25 million more there in that scenario. So that's why that payment is higher. So on the next page, we took the case 1, the $50 million project, again, assuming a 3% interest rate, and ran the math on the scenario 1, which is the ADM method. It's basically saying at the top of the page, the FY 2023 local contribution based on the budget, $4.3 million for Emporia, $6.1 million for Greensville, and we're just adding on the new debt service. You can see in the same ratios, same relationship. And you can see that the budget for Emporia goes from 4.3 plus the new debt service, their share, based on that approach, goes to $5 million. Okay, so that's the step up for the new debt. Greensville, based on the same approach, goes up about $1,050,000. So it goes up from 6.1 to about 7.2 million. And we can, again, looking at the total per pupil cost, we're still doing the math. Scenario 1 has an imbalance there. So Emporia's now with the new debt at just over 20,000, and Greensville now eclipsed 18,000 on a per pupil basis. Now, looking at scenario 4, right below that, the one difference we made here is equalizing the per pupil cost. The analysis that we went through in the previous section resulted in about an $890,000 shift from Emporia's local contribution or funding to Greensville County. If we do that analysis and that math, the adjusted local contribution now is $3.4 million for Emporia and $7 million for Greensville County before the new debt service is layered on. Once we layer the new debt service on in the middle of the page, you can see then the projected local contribution now is right at $4.1 million for Emporia and just under $8.1 million for Greensville County. But when we do the per pupil cost, again, when we do that math, both local jurisdictions are paying the exact same. It's just elevated now by the new debt service. So that new debt service is increasing that from just under 18,000 to approximately 18,900. So that's attributable to the increase in the new debt service. But you can see then this scenario 4 mathematically calculates the per pupil funding on an equal basis because we're talking about the same school system, the same sort of cost to educate the kids. The difference, we just put the math there versus the FY23, and you can see that if we do the calculations here under scenario 4, The projected local contribution is about $150,000 less for Emporia than the current FY23 budget, but for Greensville County, it's about $1.9 million more than the current FY23 budget. So that's the relative impact based on scenario 4. The next page takes the same 3% interest rate, but looks at the $75 million project. Again, the only thing that changes now on this page is the new debt service piece. That is now higher based on the $75 million project. And you could see then, if we do the math at the top, there's no adjustment. It's just a direct add-on to the current FY23 budget by the amount of the new debt service. But if we look at scenario 4, again, we're starting with the adjustment to equalize the per pupil funding, adding on the new debt service, and we can see when we add that on, we still arrive at the same total per pupil cost. So we're not, again, disadvantaging one local government over the other. It's the same calculation in terms of per pupil cost that you're paying for each pupil. So on the next page, we took this 3% interest rate scenario, and for the $50 million scenario, we tried to quantify this in terms of what we call not only an absolute dollar number, but also a equivalent real estate tax impact. And we're not saying that the revenues come from real estate or have to come from real estate, but just translating that onto, if we did it on a per penny basis, what would that translate into? So just looking at the $50 million side and starting from Emporia under scenario 1, without equalizing the per pupil cost, Emporia, you have to recall, is paying more on a per pupil basis anyway to start with, based on the ADM method. That impact of the $50 million is roughly a $737,000 impact to the city's budget, which translates into about an 18 penny impact on the real estate tax rate. That's about that number is about a 2.9% increase in the budget just to fund debt service. Now, if you look at scenario 4 for Emporia, that's equalizing the per pupil cost. Then it just so happens that Emporia's currently budgeted number is high enough to absorb the debt service when we equalize the per pupil funding cost based on the math, so there's no equivalent tax impact. But if we carry that out to the $75 million scenario, you can see that scenario 1 is incredibly high. That's just unaffordable at 30 cents equivalent tax impact. That's about a 5% increase in the budget just for debt service. But scenario 4 then still has a resulting tax impact of about 9 pennies. So you can see that the bigger the project, the more expensive the project, regardless of adjusting for the equal per pupil cost, there's still an impact at the $75 million level. For Greensville County, we did the exact same approach, the exact same math. Scenario 1 again, that is essentially the budgetary impact based on ADM. The FY23 budget would need another $1,052,000 to support a $50 million project. That's about equivalent 6.4 pennies for Greensville County, or about 4.4% of the general fund budget. Scenario 4, though, again, takes into account the equalization of the per pupil cost, rebalances out the funding between the city and the county in terms of the local contribution. And you can see that when you add on the debt service on top of that, that $50 million project is approximately a 12 penny impact, or about an 8% of the total general fund budget there. Now, when we look at $75 million, it just gets that much more expensive because we're talking about more debt service in terms of the cost there. And on the next page, what we did here on this page and on the subsequent page and the impact is we've increased the interest rate from 3% to 5%. This shows you the importance of the ability to potentially access below market cost of funds through the Commonwealth. So the debt service now is higher for both 50 million as well as 75 million. And then when you turn the page to 23, the numbers are, again, the same until we get to the new debt service. So nothing changed in the first, second, and third column for either scenario 1 or scenario 4. We're just layering on now a higher level of debt service that's additive to it and arriving at a new local contribution and sort of the relative difference between the FY23 budget, but also you can see that scenario 4 still calculates an equal per pupil cost that's being funded by both localities. On the next page, this is the 5% interest rate for the $75 million project. Again, the same methodology. The debt service here is just that much higher because we've got 5% cost of funds and now a $75 million project. Again, the scenario 4 still arriving at the same per pupil cost. So the last page here, page 25, is the summary of the budgetary impact at the 5% rate. We did go over the budgetary impact at the 3% rate, but you can see at the 5% rate under scenario for Emporia under scenario 1 or scenario 4, both scenarios result in an estimated increase. It's just that in scenario 1, it's effectively $1 million increase to the budget, translates to about 25 pennies on the real estate tax rate. Under scenario 4, again, rebalancing out the per pupil cost, so the per pupil cost funding is the same. That $154,000 impact to the budget is about 3.7 pennies. And again, for Greensville County, doing the same approach, because we're rebalancing the per pupil cost, and you'll remember that under the scenario 1, which is basis for the 23 budget, the City of Emporia is paying more on a per pupil basis versus Greensville County. When we rebalance that for scenario 4, what happens then is the per pupil cost is the same, but numerically and just in terms of cash flow that needs to go into the budget, that is additive to Greensville County's side, so Greensville County's impact goes up on top of the debt service. So that's a combination of the rebalancing of the per pupil costs as well as just adding new debt service. And you can see that under scenario 1, if we don't rebalance it, scenario 1, Greensville County has about a $1.5 million budgetary impact, 9.1 pennies roughly. But under scenario 4, it's a $2.4 million budgetary impact, roughly about 15 pennies. And if we do the math and just extrapolate and make the costs more for the project, those numbers get higher for the $75 million funding need. So that concludes the walkthrough of the projected impact of the debt service. Again, based on the concept of the current ADM approach, just on the total local contribution, which again does not take into account LCI, ability, and wherewithal to pay. And then scenario 4, based on a total per pupil cost, which does take that into account by equalizing the per pupil costs on a school system-wide basis and dividing that methodology up by math in terms of arriving at the total local contribution for each local government. So with that, I will conclude the presentation here and be glad to take some questions from the school board, county board, and city council.
I'm sorry, Roland, I'll keep throwing a few
No
at
problem.
you. Looking at debt service long-term with the new proposed debt, depending on what that number would be, does it make any sense? Probably doesn't. To take the majority, I assume, and Dr. Edwards, correct me if I'm mistaken. I'm sorry. Dr. Edwards, correct me if I'm mistaken, but the majority of the remaining debt, the largest piece, would be the elementary school that was opened in 1998, which, if I'm not mistaken, has about 5 to 7 years remaining before it's paid in full. So my question would be, if we're paying, and I don't know what the debt service payment annualized or monthly is on that, but would it make any sense, and I think the answer is yes and no, to take that debt, add it to this, spread it back out to make the impact a little less than what this impact would be? The negative to that, in my opinion, is that we're at the back end, so we're paying a whole lot of principal and not a whole lot of interest. That's the negative piece to it. And if we can live with that for 4 or 5 years, from the time that, and maybe less than that, from the time the facilities are improved, renovated, new, whatever the case may be, just have to stomach it for a while till that piece gets off, and then there would be some potential savings there. So I think I know what you're going to tell me, but I'll listen.
I'm going to show you as well. So if we can go to page 21, it's the detailed page there. And this math works for all the scenarios. So Jim, that's a very good question. And effectively, one of the things that could be done is that if we have too much payments on the front end, can we just pay it off, maybe refinance it and stretch it out, is what you're saying. If that does work on occasion from time to time, when there's a lot of debt outstanding, and the amount of debt you're adding may be a little bit or proportionally insignificant or kind of equal to the amount you have outstanding. But here, and you can see in this graph, it's really illustrated in this graph, in that the green bar, and this dark green bar is the operational piece. The debt service that you have outstanding is that light green bar that's underneath the yellow line. Okay, so effectively your local contribution takes that into account already, that piece of debt service, and what we're adding on top of it is essentially accomplishing what you're saying in concept. We're wrapping or structuring the new debt around so it's not adversely impacting the first initial years. So you can see that as we go up, the new debt service is not as big in the first 5 years. But when the debt service is paid, the old bonds are paid off, it absorbs the entire debt service budget. So you're not increasing, you're not decreasing, you're level funding your payments over time. We've essentially accomplished your question without restructuring the debt.
All right, my next question would be in reference to rates. We've seen significant increases in the last 12 months. We're probably going to see, and this is Fed rates, I understand, and we're probably going to see another bump tomorrow. And I assume the first 6 months, probably another bump or two. We don't know. Obviously, we don't know. In the inverted yield curve that we're in today, it looks like that we could have some relief 2, 3, 4 years down the road. So do you think 3%, if we're looking at this, is a good estimate at this time? Do you think 5%? I think 5 is a little high for a government entity, but I'm not sure about the 3 at this point.
Yeah, the 3% is assuming that you have the ability to take advantage of, and this is what's unique with city and the county, is that Emporia has a local composite index in the 2 to 299. Greensville is in the above 4. So if there was the ability to get the advantage of that 2% LCI in terms of funding, then 3% would be an average cost that would make sense. 5%, again, I think what we've seen is the yield curve. When we started doing this analysis, everything was just going up and up and up. We've gotten a little bit of relief now in terms of long-term rates coming down. So I would say that rate is probably more in the 4% range. Okay. So the aspect though is this is far out. Unfortunately, we don't have a crystal ball. So 5% adds a little bit of what we'll call cushion for planning perspective, knowing that it's probably giving you a little bit of room so that if that rate comes in a little higher than 4, you're going to be better than that. But obviously we don't know where in that market will be. But it gives you a little bit of room if that rate goes closer to 5 and we start seeing rates kind of get out of control in that respect. We at least have sort of an outside range of what we think is reasonable.
All right, last question, I'll give it to somebody else. When we go to find this money in whatever lending authority we go through, I would think it will be important for us to have audits that are in pretty good condition, that are showing that we're financially responsible.
Right.
Where we're running positives rather than negatives, and the trends are in the right direction. So for both of us at this point in time, to me, this is a step that we need to make sure that we're aware of while we're budgeting going forward. If this is in the 2-year plan or 3-year plan, we're going to want to have those 2- and 3-year budgets to be as positive as possible, because every percent, 0.5%, 0.75%, 1.5% can eat us up in cash flow, which becomes just another burden to the local taxpayers.
Correct.
Is that fair? Fair
Yeah,
assessment?
that's a fair statement. I mean, I think the audits are pretty much a given, you know, when we think about that in terms of that, but also structurally balanced budgets and good fund balance reserves. Those are very important, both for the city and the county.
Mr. Saunders, I just want to make sure, your first question, the debt service is at Wyatt Middle School. No, sir, Wyatt. For the improvements is what I'm showing. 2009, when we renovated Wyatt Middle School. We'll pull it up and I can tell you, sir. Yes, sir.
Could they have done a 20-year note?
Yeah, I'm trying to pull it up. Yes, sir, I can definitely get everyone that information, I just can't pull it up.
That's fine.
Yes, sir.
Just sometime, that's fine.
Understood. Yes, sir, thank you.
Is there any other discussion between the boards? Any other questions for the Davenport group? Sure.
I'm sorry. I'll let everybody leave. Ma'am?
There's a question over here, and then you can go after him.
Okay, that's fine.
From the school board standpoint, this proposed school debt, I'm guessing that's just used for example, the 50 million and the 75 million, because we have not hired an architect or got any pricing on any new school systems.
Their scenario.
Okay. Thank you.
All I was going to do is make a comment, and the comment is, number one, thank you guys for all the work in your firm that you've done on this, and I know on behalf of the city, we appreciate all the leadership and guidance you've given us over the years, because financially, we were in some tough spots years ago, so thank you for that. And number two, I'd like to commend the turnout tonight. The turnout for this has been the largest turnout I've seen for any open forum probably since I've been on council, and I can assure you, I'm old, that's a long time. But thank you so much. You get to hear it and see everything up front, not hear it on the street, and we know how things change on the street. So thank you for being here.
Yes, and I'd like to reiterate what Mr. Saunders has said. I want to thank school board and city council and all the participation, as well as what Davenport has done, put together for us. So we thank you all for being here tonight. If there's no further discussion or questions, I'd like to entertain a motion for the Board of Supervisors to adjourn.
Mr. Collins, I want to thank everybody for coming also. think we made a little progress tonight. Hopefully, we're all headed in the right direction.
Well, this is what we gotta do. We gotta all work together.
I move we adjourn.
Motion's been made and second. All those in favor signify by saying aye.
Aye.
All opposed, motion carries.
Now, the school board seeking a motion for adjournment. Motion's been moved and properly seconded. All in favor, make it known by saying aye. Aye. All opposed?
May I have a motion? I would like to make a motion that the city council would be adjourned. Could we have a second? Second. All right. Roll call.